Hello, everyone. Welcome to this week's Mortgage Minute. I'm Alvarez at MortgageWorks, where we have the answers and they're on the house. Let's get right into what's going on with the bond market and interest rates. As I mentioned to Jeff, the media, I think the public is sort of wringing their hands again because, well, rates are kind of climbing back up. We hit a low point late December, right after Christmas. And since then, that was back when the 10-year Treasury bond yield was about 382. It's much higher now. There's our rate grid. This was updated this morning, so this reflects the current rates, rate indications, I like to call them, as to what's possible with both conventional FHA, VA, jumbo, as well as equity loans, home equity lines of credit, and fixed rate seconds. So we are still in the sixes. Now, granted, we've kind of creeped up into the mid to high sixes on conventional. FHA, VA is broke through the 6% barrier, but still just barely over at about 6.1. So not, historically terrible, but definitely the enthusiasm for a bunch of rate cuts coming has subsided quite a bit. In fact, Jeff's going to pull up the 10-year Treasury bond chart, and you can see how the movement has been, pretty elevated the last 5 days. It was only last Friday when we got, down there under or close to 420, and it's been pretty much 4.25, 425 to 435 cents. And so it's really strange because we had such optimism, again, late December, right after the last Fed meeting, when it was perceived that the Fed was done with rate cuts and we're going to start dropping the Fed funds rate and start doing so aggressively. Well, you know what? That narrative has changed. That was then, and this is now. So why the change? Why the change in perception and expectation as to rates? Well, this week, the primary trigger, I think, was the release of the Fed minutes. Now, the Fed minutes are the written, basically the written minutes of their last Federal Open Market Committee meeting, which again was in December, when at that time, right after the meeting, the press conference led the market to believe that the Fed had pretty much got to where they were going to stop raising the Fed funds rate and would have multiple reductions in the Fed funds rate this year. Well, as it turns out, with the minutes being released this week, a whole different perception, a whole different scenario has been identified. And now, to put it in a summary fashion, as the bullet point suggests, they're more worried about cutting rates too fast than moving too slow. So the Fed is definitely going to be biased toward going slow with rate reductions. So at one point, late December, there was talk about 6 reductions in the Fed funds rate in 2024. Well, now the Fed funds future market has changed to where the predictions now is we won't even see a cut in the Fed funds rate until June. That's 4 months away. So it looks like, as the slide at the bottom says, it looks like we're going to be looking at rates higher for longer. Now, that being said, there's also other news out there that would seem to run counter to this narrative. Wells Fargo, for example, believes that the job market is weaker than it looks. And they're predicting that steep rate cuts will be coming this year. In fact, they're predicting the Fed funds rate will be reduced by 1 to 1.25% in 2024. And if the typical adjustment is 0.25% increments at a time, that could still be 4 to 5 rate cuts this year. So that kind of goes against the current narrative that it's not going to be that strong and that frequent. But the underlying point with Wells Fargo's take on rates is really, if you think about it, it's all about the job market. The labor market is really probably the biggest factor as to where rates are going to go. And the problem has been a lot of the data points for jobs, the labor market, have been pretty strong. Wells Fargo is skeptical, though, and that's why they're suggesting the jobs market's not as strong as it looks, and that's why they're predicting these rates to start coming down. And as it relates to recessions and the labor market, because there's still some folks out there predicting a recession, they're in the minority now, but the 2-year Treasury bond yield is still higher than the 10-year, and that's a reason why we're probably still potentially going to see a recession. But more importantly, I heard an interesting comment or sort of a rule that a particular financial market pundit threw out that I really kind of caught my attention. I thought it was a pretty good way to look at this. It's the 4 and 4 rule. The suggestion being that what to look out for in terms of a recession coming is the 4 and 4 rule, meaning unemployment rate gets over 4% and real wage growth drops below 4%. And we're really close to both of these right now. The unemployment rate is in the high 3s. Wage growth has been higher. It looks like it's starting to slip a little bit. And if wage growth goes under 4%, then we're essentially at zero wage growth or even negative wage growth when you take into account current rate of inflation, which is still running in the 3 to 4% range. So overall, therefore, keep an eye on these two data points, unemployment rate and wage growth. If we see unemployment creep up over 4, we see wage growth drop, start to trend down below 4%. That's probably a pretty good indicator we could, in fact, still see a recession despite the strong data points we've been seeing up till now. So again, we're not in the 7s. We are elevated. We're in the mid to high 6s conventional, very low 6s on FHA, VA. So if you're hearing 7% or you're contemplating getting a loan and being quoted 7%, give us a call. I think we can show you some better numbers than what you're hearing.